The world is going to shit whether you like it or not. The chart of truth is the trend that I'm talking about. The demographic trend where lower and lower interest rates create the same outcome. Every time we get to the top of the chart of truth, we enter a recession. There's always a crisis at the top. Now here we are breaking out of the top. We broke out of the top in 2018, which is a very similar setup than we have now. No ever cycle in the chart of truth has ever gone above the previous cycle peak. So this one is about 3%. Could something be changing here? Possibly. Is it? I don't think so. My technical analysis work, I use a lot of DMARC, suggests that the bond market is going to peak in yields any day now. Will probably be a rolling peak over the next couple of months. And that will be the peak in the cycle of interest rates. So we've got a short, sharp cycle, something we've not had for a very long time. It looks like it's breaking out. It's not unusual to be breaking out. So if I look back and pretend we're back in 2018, well, back in 2018, if we drew the chart of truth, obviously the trend channel, because it's a log trend, it's a regression trend, redraws itself with the different peaks in it. And we broke over for an extended period of time, as we're doing now. People have a memory of bad times. They've got a recency bias, and the 70s is their framework. That's the framework everybody looks at. We're going back to the 70s. Everybody needs to be Volcker. I mean, even the bloody Federal Reserve are dropping Volcker's name like, this is what we need to do. We don't have anything similar in setup to the 1970s. The argument is globalization is in retreat. So supply chains are going to be continually under pressure that's going to push up prices over time. But I'm not sure the rate of change is going to go up. So are prices going to go reset at a higher level? Most likely. Rebuilding local supply chains and factories, bringing energy back to Europe or bringing factories to the US creates demand and is inflationary because you're building stuff. Fixed investment, which has been lagging for decades, nobody was investing. Maybe that comes back and that creates stimulus in the economy that is inflationary, competition for, cement and copper and all of those things. Wages going up at the expense of profits. So a lot of people think, wages are going to keep getting bid higher, and the shift from wages, from capital to labour is an ongoing trend. The other one is there's a secular rise in commodity due to underinvestment. And the other one is fiscal policy is the new big thing. Fiscal policy is inflationary by nature, and it's ongoing. And therefore, we're going to see a higher level of inflation than we've seen in the past. And I think if you ask most of the experts that I've spoken to in my Journeyman series, most would say, look, 3 to 4% inflation is what they're thinking, and that bond yields could, peak out of 5 or 6% or 5%, let's say. Nobody's being alarmist here, but the structure has changed. Therefore, the chart of truth have changed. Some would say, well, maybe we stay in a wide elevated band, that we don't break higher. Others are seeing inflation or interest rates go, 8%. So that is the bear case. That's the opposite case to mine. And again, credible people, credible views. But I have a different view. I kind of think that this is the 1940s all over again. And that is the framework I'm using and not the 70s. So these things are all happening. We've got a fourth turning moment. And I think that we go back to the start of the last fourth turning actually to get a better understanding. That last point was after World War II. After World War II, we had the biggest supply shock the world had ever seen as demand came on globally. And what we saw was an explosion in prices. But inflation then fell back because of demand and settled into a period. Debt GDP coming out of the war was extremely high. But financial repression of not letting interest rates rise too much, but letting inflation run a little bit, 3%-ish, eroded the value of the debt over a 15-year period, and debt didn't become the issue. And over that period, much like now, fiscal policy was king. It was enormous. We had everybody rebuilding everything globally, Japan, Germany, Europe, US, everything. We had a massive fixed asset investment boom in factories, houses, roads, cities. It was just gigantic. And the population exploded with baby boomers, kids, everything. So it was an extraordinary period. Now, if you'd have told anybody we'd get that set up now, they'd say, yeah, inflation's going to the moon, everybody's screwed, the market's going to get destroyed, this is terrible. That was not the 1940s and 50s at all. It was in fact a period of incredible growth, massive adoption of new technology, a rise in house prices, standard of living, and markets themselves. Yields didn't explode higher. It went between 1% and 3% for the entire period. I think that's what we're going to get to now. We have a once-in-a-lifetime opportunity where we may see a boom based on the retooling of the global economy, but it's not going to be as inflationary as people expect. So if you're looking at this slowdown that I'm also picking up in my indicators, it's not clear outside of the yield curve. There's only a few things that have got recession kind of written all over them, so it's not consistent yet as far as I can see. But it feels to me that we're at the tipping point where the inflation pressures start coming off and the year-on-year rate of change starts going down, and we start to see ISM slow down heading towards 50. And that looks like it's the next kind of 3 to 4 months we start seeing that. What happens to the market? Because I think the market fundamentally has changed because of the reaction function from central banks. So historically we had, a recession would lead to a 50% drawdown that lasted 18 months or so. But it feels like the currency debasement side of stimulus and monetary policy changes that. How are you thinking through all of that?
We're beginning a paradigm shift. A paradigm shift is a shift from a mindset, one mindset, and positioning of that mindset to another mindset and another positioning of that. For example, the mindset that we were in was that you have low inflation when you're owning bonds and you're owning cash, or you are operating one way. And you don't worry about that, and companies don't worry about it in their inventories, having larger inventories, or homeowners don't worry about inflation as much in the purchases of the houses and so on. Once that shift begins, it causes a reinforcing dynamic. It's like everybody is long bonds. We've been in a 40-year bull market in bonds. And when that shift starts to take place, you see behavioral shifts that reinforce that cycle in the paradigm. So, for example, when there is the selling of bonds, that it makes it more inflationary in and of itself, because the amount of debt that has to be sold is not just the deficit, but also the amount of debt that's being sold is those bonds. So now interest rates have to rise a lot, or the Federal Reserve has got to come in there and buy more. And then you get wages. People make wage settlements, such things. So a paradigm shift is beginning to take place, and that will be also self-reinforcing. And it's taking place in this context of the conflict, which then creates the breakdown of efficient systems. Each country wants to be self-sufficient. It needs to protect itself. And in being self-sufficient in that way, then you have less efficiencies in the system. All of that becomes self-reinforcing. It's all happened before. It's all happened many, many times before. That's covered both in the video and the book. So it's, I'm concerned about that. So what you have is enough tightening by the Federal Reserve to deal with inflation adequately is too much tightening for the markets and the economy. So the Fed is going to be in a very difficult place a year from now as inflation still remains high and it starts to pinch on both the markets and the economy. Here's the problem. If you're borrowing more money than you're lending and you have a lot of debt, you either are going to pay back in hard money or in soft money. And so it creates a very difficult trade-off. So what can you do? Do you spend less money? So that the trade-off becomes more and more difficult. And that's what brings about a stagflation environment, because they tried to navigate between those two undesirables. In other words, they want to contain inflation, but too high of an interest rate that's good enough for inflation causes too much economic environment. So what can they do? No, they're in a position already because of that dynamic spending more than they're earning, creation of a lot more debt, and a lot of other debt, which one man's debts are another man's assets, and that as the holder of that assets is losing money. Imagine holding a bond now, and look at how much money is in bond funds and cash. Okay,